everyone. Welcome back to Chapter 6, Multifactor Model. Today, we will continue to discuss the multifactor model, the 6.3, the application of multifactor model, which is how can we doing the empirical study using the multifactor model. Now we will begin with the Pharma French 3-factor model first, and then we will introduce Carhart 4-factor model, and the last one is MSCI Barrer model. So let's have a look. The first, one of the most important model is by Chen, Rao, and Rose in 1986. This is the model they used to anticipate, to analyze the return for the stocks. And they use the economic factors in their models. Let's have a look at these factors. The first, they use RM. That's the return on a value-weighted index of New York Stock Exchange listed stock. And then they use MP to denote the monthly growth rate in U.S. industrial production. And DEI and UI, both of them are considered the inflation. So DEI is the change in inflation, and UI is the difference between the actual and the expected level of inflation. And the next one is UPR. UPR is an anticipate change in the bond credit spread. And the last one is UTS. This UTS is an anticipated term structure shift, which is the long-term yield minus the short-term yield. So that's the economic factor model used by Chen, Royal, and Rose. Now let's have a look at the result, the regression result for this model. We know that from this table, we know that there is quite difference between the regression result, the slope, and the significance. And it will change differently based on different time period. From this empirical study, they use the stock from the New York Stock Exchange, and the time period is from 1958 to 1984. And these three different time periods are the subset. So we subset it by 10 years, and the rest of the time period. So let's have a look at the result here. For the result for DEI and UI, which are the two factors to denote the inflation. So let's have a look. The result here are the T statistic in the parentheses. So here are the T statistic in the parentheses. Let's have a look. Only this period, you can see the T statistic. Only in the 1968 to 1977, this period, our regression results are significant. And for the rest of the time period, it is insignificant. It's not significant. So that's the first conclusion difference. And the second one, let's have a look at the result for our market. For the market risk, let's have a look. Our result is always insignificant, different from zero. So which means our market could not explain this individual stock, each individual stock's return. Doesn't work. So that's the basic empirical result you can understand. Now let's have a look. I summarized there are three different groups of stock that tend to have higher return than those of predicted solely by their sensitivity to the market return. What's the conclusion? We find that from the empirical study, small capitalization stocks got a higher return and a high price-to-book ratio. Price-to-book ratio stocks, they have the higher return. The last one is the stocks whose price have been rising that has higher return. Let's have a look at the first one, the small capitalization stock. The small capitalization stock, which is measure the size of the stock. So in the market, we might have different categories like small cap and big cap and mid cap. So we compare the result for these three categories. We find that the small cap have the higher result. And the second conclusion is the low price to book ratio. So this low price to book ratio or low price to PE ratio, which means our stock is the value stock. So from this conclusion, we know the value stock might have a higher expected return compared with the growth stock. So you need to know the low PE and low PB means the value stock. Opposite to that, the higher PE or higher PB ratio means that the stock is growth stock. And from the empirical study, we find that the growth stock's return is lower than the value stock's return. The last one is the stocks whose price have been rising. We call that the momentum effect. This momentum effect means we assume that the stock increased previously and it will continue to increase in the future. So that's the momentum stocks. In China, we have another name means 追涨杀跌. So we have lots of investors, they will assume that the market will follow this one. So if they find that the stock is previous increase, they will buy these stocks. So that's the three basic conclusion we find from the empirical study. We conclude that small cap, low PE, or the momentum stock will have a higher return. The other conclusions, we find that the high dividend stocks and also some stocks, they have low volatility stocks, they might have higher returns. We will discuss them in the later chapters for the mutual fund strategy, so we can learn that later. So based on these three basic conclusions, if we use these two, we will form the Pharma French three-factor model. So this conclusion cannot be explained in CAPM, capital assets pricing model. So that's the basic criticize for CAPM because it cannot explain why small cap, low PB, and the momentum stock, they will have a higher return. So let's have a look. The first one is Pharma French three-factor model. That is founded by Pharma French in 1993, and this is developed a multi-factor model specifying the risk factor in microeconomic terms using the characteristic of underlying securities. So here we can have a look in this equation. The difference here is on the left-hand side, we use the excess return, which is individual stock return minus the risk-free rate. So as I mentioned before, for this RI, we can use the nominal return or use the excess return. And here, the first part is our market risk, which can measure by beta, the systematic risk, to measure the market risk. And the second part is the SMB. So what's the meaning S and B? So this S means small, this B means big, M means minus. So here, let's have a look. The SMB is small minus big, which is the return to a portfolio of small capitalization stocks less the return to the portfolio of large capital stocks. So in the empirical study, definitely we have lots of stocks in your portfolio, and you will separate them for two different portfolios. One is small cap, the other is big cap, based on their market capitalization. So we can use the small cap group stock return minus big cap group stock of return, portfolio return, we get this S and B. And the next factor is our HML. So it's the same one. H means high, L means low, and M means minus. So that's HML means high minus low, which is the return on a portfolio stock with high ratio of book to market value, and less the return to portfolio with low book to market value. So that's the book to market value. It's not the same as we mentioned price to book value. So that's the opposite one. So why, as I mentioned, the low PB ratio will have a higher expected return. So here, if we use the book to market ratio, it should have a high book to market ratio will have a higher return. So that's the reason why we use high minus low here. So we got all these results to separate groups, and then we ran this regression, and we have this result here. Now let's have a look at the result. If we don't run the multi-factor model, we use the single factor model, and we have two different portfolio groups. One is the lowest PE portfolio, and the other is highest PE ratio portfolio. And we compare the BI here, the beta I here, the lowest PE portfolio, which has 0.94, and for the highest PE ratio portfolio, which has 1.1. And it is significant. And here is our multi-factor model, and for the multi-factor model, we can compare the lowest and highest. The regression slope is 1.03 to 0.99. The difference between these two groups for the multi-factor model is much smaller than the difference between the single-factor models. And the second one, let's have a look at the other two factors, SMB and the HML. For the SMB, we have seen that the lowest PE groups, they have the slope coefficient is 0.24. And this is significant different from 0, which means for this group's portfolio, the small size stocks will have a better return result compared with the big cap. And for the highest PE ratio group, this coefficient is minus 0.01, but it's not significant different from 0. So it's the opposite result. However, it's not significant. And let's have a look at the HML. This for the high book to market ratio, and both of them are significant, coefficient are significant. For the lowest PE groups, they have the M minus L is 0.67, which means the high is high book to market ratio give a higher return, and it's consistent with our results. But for the highest PE ratio, it is the opposite result here. So that's the empirical study result for the Pharma French 3-factor model. And this model will widely used in empirical study and used in the mutual fund study in the previous years. But now with the development of our theory and models, definitely we can use others, 4-factor, 5-factor, 6-factor, etc. Other models we will discuss later.